So there are many different ways you can invest your money, like retirement accounts and bonds, which with each having a different tax system. But for today, we'll be focusing on stocks and mutual funds, and specifically on the capital gain aspect of tax, and addressing how much tax we need to pay for capital gains. Okay, so first, what is capital gain? A capital gain is essentially the profit you earn when you sell a capital asset, such as stocks, mutual funds, real estate, etc., for more than what you originally paid. But for now, we're just talking about gains from specifically stocks and mutual funds only. So, an example of capital gain is if you buy a stock for $100 and later sell it for hypothetically $300 once the price goes up. That $200 difference is your capital gain once you sell that stock. If you don't sell that stock, then it is called unrealized capital gain because you haven't cashed in or basically realized that stock yet. Okay, so capital gains can further be divided into two subcategories, which are short-term capital gain and long-term capital gain. Short-term capital gain is when you sell an asset or stock you have held for 1 year or less, while long-term capital gain is when you sell an asset you have held for 1 year or more, over a year basically. So, however, the thing about capital gains is that when you sell an asset for more than what you paid, so basically just when you make capital gain, it counts as profit under, the profit counts as income under federal tax law. But why is this? Capital gains are a revenue source, and accepting them from taxes would mean favoring investment over labor income. It also prevents people from avoiding taxes by shifting their earnings entirely into investments. So, say if investment income weren't taxed, then people could structure their finances to avoid taxes almost entirely through investing, and the government doesn't want that. And then capital gain, capital gain taxes provide an important source for government revenue. So there are two types of taxes that can apply to capital gains, that can apply to investment profits, which are capital gains tax and net investment income tax. So I'll go more in depth on net investment income taxes later, but for now, let's just look at capital gains tax. So if you remember from before, capital gain is split between short-term and long-term capital gain. But the thing is, short-term capital gain and long-term capital gain have different tax rates. Is everyone good with that so far? Just pausing real quick. Yep. Okay. All right. So let's take a look at short-term capital gain tax first. Here we have a chart of tax rates in 2024 for both single and married people. And again, short-term capital gains happen when you buy an investment and sell it in less than a year. So short-term capital rate is taxed in the same way as ordinary income. On the chart, you can see that as income increases, the tax rate also increases, starting at 10% and going all the way to 37%. This means that as you make more from your investment, you'll be taxed for more. The way I like visualizing this chart so it's easier to remember is kind of like the layers of a cake. So each layer represents a higher income range and a higher tax rate. So this cake specifically represents the tax rate for single tax filers who make 47,151 to 609,550. So, for example, income above 47,151 begins to be taxed at 22%. Income above 100 and 500, 100,526 begins to be taxed at an income at 24%. Income about 191,951 is at 32%, and then so on and so forth. So only the income that falls into each layer is taxed at that layer's rate. All right, so now let's take a look at long-term capital gains tax. So long-term capital gain happens when you hold an investment for more than 1 year before you sell it. So on this slide, you can see the three main, here, let me grab out the laser pointer. Here you can see the three main long-term capital gain tax rates for 2024. 0%, 15%, and 20%. And again, let's just focus on, I'm struggling with this. Let's just focus on, let's just focus on single tax filers. So for single filers, if your taxable income is up to 47,125, your long-term capital gains may be taxed at 0%, meaning that you don't pay any federal tax on those gains. As income increases to above 47,025, the tax rate raises to 15%. And for the higher incomes of 518,900, the rate becomes 20%. Okay, so now let's compare taxes on long-term and short-term capital gains. Okay, but before, does anyone have any questions or like want me to go back to one of the slides from before to possibly see the rates again or? Yep, okay. Okay, so yeah. Okay, so comparison between long-term and short-term tax rates. So here we have small snippets of each graph. But to make this a bit easier to just like analyze, let's just focus on specific boxes. So we can see that while long term, the top one, long term, while long term capital gain isn't taxed until over $94,050, short term capital gain is immediately taxed for 10%. And then furthermore, if we compare the same amount of gain, say around 500,000, for example, just in between here, we can see a big difference between the tax rates. The tax rate for long-term capital gain, if you made $500,000, is 20%. While with short-term capital gain, if you make $500,000, then that tax rate is 35%. This means the same 500,000%, the same $500,000 gain can be taxed more heavily if it's short term rather than long term. So the key takeaway from this slide is that capital gains, long-term capital gains, aren't taxed like regular income the way short-term capital gains are, and instead, long-term capital gain is taxed at much lower rates compared to short-term capital gain. Basically, the government rewards long-term investment as opposed to short-term investment. So by holding an investment for at least 1 year or more, investors often pay significantly less tax than they would have on short-term trades. So this difference in tax treatment is one of the main reasons long-term investing is so popular. All right, so now let's talk about net investment income tax, which is another tax that is added to capital gains. It is also known as NIIT for short. So NITT, or net investment income tax, is basically a bonus tax that applies to higher income investors on top of both long-term and short-term capital gain taxes. So the set net investment income tax rate is 3.8%. However, this tax only applies once your income reaches certain levels, so if it goes above certain levels. So for single tax filers, this threshold is $200,000, and for married couples filing jointly, this threshold is $250,000. So if an investor's income is above these thresholds, the government basically just adds this extra 3.8% tax to their investment profits, which includes capital gains. But keep in mind that most everyday investors don't pay this tax. It's just for higher income households and acts as an additional layer on top of the regular capital gain taxes. So basically, if you make under 200,000 as a single person or under 250,000 as a married couple, you just don't need to pay this tax. Any questions or just slowing down because I went through that a bit quickly? Just given extra time to look at this. All right. So now, how do taxes affect investing in an index fund like the S&P 500, which are basically just the top 500 stock companies that are invested in the US? So in order to decide that, we need to solve for how much you can make with or without taxes. So there is going to be a bit of math, but it's not too difficult, so bear with me. So here you can see we have a chart of just like the same stock, just in different years as the price goes up or down. So for calculation's sake and to make this like a bit more easier to read, let's just focus on this one highlighted row, okay? Just calculate the amount for one highlighted row. So let's assume that your investment for this stock is inside a tax-sheltered account. A tax-sheltered account is just an account where you don't pay taxes on investment gains each year. So that means you have $0 in taxes. So here the investment earns 599 in income and $49 in capital gains for a total of 648 made. So plus them, add those together, yeah, $648 made from this stock. So now let's assume that you want to reinvest everything you made back into that same stock. So because this is a tax-sheltered account, the taxes paid are $0. So that means that full $648 can be reinvested back into the fund. So to figure out how many new shares can be purchased, we need to divide the reinvested amount by the fund's net asset value, or NAV. You can see NAV right here, NAV $14.64. So which equals, so just divide those together to get 44 new shares. And additionally, at the bottom of the slide here, we can see how the total worth of our stocks in 2019, it would be worth $845,793. So that is important to keep in mind for later. So just keep that in mind. All right, so let's see what happens to this same investment when not in a not tax sheltered account. So that means we have to pay taxes on income and capital gains each year. All right, same investment. So in this example, the investor is in a high tax bracket. So according to that short-term cake from earlier, the graph that was about that said that stated each percent of tax for how, depending on how much you make. Their ordinary income tax rate should be 35%. But because they make over 200,000 as a single person, we need to add the extra 3.8% net investment income tax. So that makes the total tax rate 38.8%. And then for long-term capital gains, the tax rate is 15%, according to that the long-term capital tax gain rate chart. And then we also need to add the 3.8% because their income is over 200,000. So that gives us a tax rate of 18.8%. So back to our same row from the chart here. So the investment earned $571 in income and $46 in capital gains. So now we first just calculate the taxes owed. So we need to take the income and multiply it by 38.8%, while also taking the capital gains and multiplying those by 18.8%. And then afterwards, we just add those amounts together to get the total amount of taxes paid in that year, which is equal to $230. So instead of reinvesting the full amounts like in the tax sheltered account, we now have to subtract 230 from the amount we can reinvest. So total amount we made and then subtract, and we get $387 to reinvest. And then finally, to decide how many new shares we can buy, we divide 387 by the NAV. So previous NAV still the same. So we get that, and then we get 27 new shares. So now remember the earlier market price of around like 800,000 from before? So now we have taxes. So if we look at that same total amount at the end, we can see that it is worth 506,118 in 2019. So that is like around like 300,000 less than without taxes. But you might also be wondering, like, does this entire $506,118 all belong to you since you just made it from that stock? Well, unfortunately, the answer is no. So we still have to subtract the amount we invested from the beginning, which is 10K, and then the amount reinvested, which is $81,141. So from this, we get $414, 414,977. And then we need to multiply that even further by the capital gain tax rate, since after all, the money we made from the stocks is capital gain. So multiply that by 18.8% to get $78,015 and then in taxes, and then subtract the tax from the total amount made to get $428,102. Okay, so now that we have done all of that math, just math is done. Yay! Let's compare tax sheltered index funds and index funds that have taxes. So no tax versus yes tax. So with tax-free investment, we invest 10K and get 845,793 back. But with taxes, however, we invest 10K and only get 4,208 402 $428,102. With tax investment, you can get 27 new shares if you reinvest everything it back in. But compare that with the 44 shares we could buy in the tax sheltered account. Right away, you can see how taxes slow down your growth and profits. Over many years, this difference just becomes larger and larger. So by the end of the timeline, we can see here the amount we made from this stock is cut in half compared to if we have taxes or versus if we don't have taxes. Okay, so now that we understand how taxes affect investing, let's talk about the three ways investment accounts are taxed. So there are three main types of accounts, which are or taxed yearly. You have tax deferred and you have tax free. So here, let's just like these are all the possible examples of types of accounts you can make under types of accounts you can make under these taxes. There's like even more, but these are just like a couple examples, just throwing out names for just sake of it. So, okay, so first we have tax yearly or yearly taxes. So these are everyday accounts here. We have checking, savings, you have standard brokerage accounts where you can buy stocks and mutual funds and etc. So as the name suggests, each year you pay taxes on interest, dividends, and capital gains whatever it is, you just pay yearly interest. This money is very accessible, but you lose some of the power. You lose some of that money to compound growth from the taxes. And then second, we have tax later, which is also called tax deferred. So with these accounts, you don't pay taxes each year on growth. So instead, you pay taxes when you withdraw the money, which is usually during your retirement. So when you take the money out, it is taxed according to the income rates when you take the money out. So that means if you invest your money in, like, say, just like a 401k or something, when your tax rates are at 21%, but you take that investment money out of the 401k when the tax rate is 19% or something like that. So you'd pay the 19% rather than the 21%. So the benefit is that your money grows without annual taxes and that you may be in a lower tax bracket in retirement. So you pay less eventually in taxes. So the downside is that those taxes could also go up during the years if you eventually end up making more money as you get older. And then early withdrawals also sometimes come with penalties. So if you invest in a tax later account or tax deferred account, you need to leave that money in there for a certain amount of time until like a certain age, unless you just want to get taxed extra, especially for the 401k, which is age 59, I think you take it out or something, I'm not sure. And then third, we have tax advantage. So these accounts, you pay tax immediately based on your current income, before the money goes into the account. So because the taxes are already paid, investment growth and withdrawals are usually tax-free, and you don't need to pay anything on deposit or gain. However, that does mean that you start with less money invested originally because you're just taxed off the bat. And at times, you might find that you end up paying more tax doing the tax advantage and doing the tax later than compared to you might you might pay more tax now than compared to later if your income tax rate ends up being lower in retirement. Okay, so okay, everyone got that right? I should probably just, yeah, just like sitting here. Yeah, so these are different. Yeah, that is wrong. Okay, so which tax is more preferable? Okay, so it is really up to you and your financial situation. So here, yearly tax accounts are the best for when you need flexibility with your finances or have short or medium term goals. Since there aren't any age limits, withdrawal penalties, or waiting requirements, you have full access to your money anytime. So it is very flexible. A tax later and tax advantage are more for when you want to save money without being able to use it. So, meanwhile, tax deferred is often more preferable if you earn a high income now and expect lower taxes later, have a lower income in retirement, since you avoid high taxes today because higher taxes, the higher income, higher taxes, and then, so you avoid higher taxes today and may pay lower taxes later when you withdraw the money. So you skip big taxes now and just pay the smaller taxes later. And then on the other hand, tax advantage is often preferable if you're in a lower income tax bracket now or early in your career and just like making less overall, and you're expecting higher income in the future. You basically just lock in today's lower tax rate and avoid paying higher taxes when you're older and possibly earning more. But overall, there isn't really one perfect account. The best strategy people do is just do a mix of all three of these so you can control when you pay taxes and keep more of your investment growth while also balancing your present and future finances and just overall doing what you need.